Breaking news. President Donald Trump has just signed a landmark executive order, one with the potential to dramatically reshape the future of retirement investing and the entire U.S. financial landscape. For years, alternative assets like cryptocurrencies, private equity, and tokenized real estate remained largely out of reach for the average American investor's 401k, locked behind regulatory walls and conservative industry oversight. But today, that all changed. Instructing the Department of Labor to review and modernize its guidance, Trump's directive has set the stage for a new era, one where Bitcoin, Ethereum, XRP, and other digital assets could soon become staples in retirement portfolios nationwide. Let's unpack what this means, why it matters, and what it could mean for your financial future. The significance of this executive order cannot be overstated. By opening the door to alternative assets in 401k retirement accounts, the administration is signaling a fundamental shift, a move toward democratizing access to new investment frontiers that were previously reserved for hedge funds, venture capitalists, and the ultra-wealthy. For the first time, mainstream retirement savers may be able to allocate a portion of their nest egg to digital assets, private equity funds, and even tokenized real estate, diversifying their portfolios in ways that were never possible before. The timing couldn't be more dramatic. Bitcoin, which had languished below the $100,000 mark after a turbulent year, surged past $117,000 within hours of the announcement. Ethereum followed suit, leaping to $3,800, and XRP broke the $3 threshold for the second consecutive day. The crypto markets responded with enthusiasm, but this wasn't just another rally fueled by speculative fervor. It was the market's recognition of a seismic regulatory shift, one that could unlock nearly $9 trillion in retirement assets for digital investments. Consider the implications. Retirement accounts represent the single largest pool of investable assets in the United States. Even a modest reallocation, say just 1%, could send billions, perhaps tens of billions, flowing into the crypto sector. Institutional adoption, already on the rise, could accelerate further as financial advisors and retirement plan managers scramble to offer competitive products and keep pace with evolving investor demand. But the news doesn't stop there. Ripple, one of the most prominent players in the cryptocurrency space, has just announced a $200 million acquisition of Rail, a leading stablecoin infrastructure firm. This strategic purchase is designed to expand Ripple's footprint in digital payments, with a particular focus on its own RLUSD stablecoin. RLUSD, which recently crossed the $500 million market capitalization mark, is rapidly gaining ground and positioning Ripple as a direct competitor to established digital payment giants like PayPal and Circle. By integrating Rail's technology, Ripple aims to streamline stablecoin transactions, improve liquidity, and offer seamless payment solutions to consumers and businesses alike. This move is emblematic of a broader trend. Cryptocurrency companies are no longer just chasing speculative gains. They're building infrastructure, forging partnerships, and vying for dominance in the trillion-dollar payments industry. With regulatory clarity now provided by the Genius Act, signed into law just weeks earlier, the path for stablecoins is clearer than ever. The Genius Act mandates that stablecoins must be backed one-for-one by U.S. dollars or other low-risk assets, enhancing transparency and consumer protection. In effect, stablecoins are now legally recognized as money, ending years of legal gray area and paving the way for their integration into traditional financial systems. For everyday users, this could mean stablecoins become as ubiquitous as cash, facilitating instant payments, remittances, and cross-border transactions with minimal friction. For investors, it signals another step toward mainstream adoption, with regulatory guardrails that can attract institutional money and reduce risk. Meanwhile, the ETF landscape is poised for its own revolution. According to Stephen McClure, CEO of Canary Capital, the Securities and Exchange Commission is finalizing a generic listing standard for crypto ETFs, which could pave the way for funds based on altcoins like XRP, Litecoin, and Polkadot as early as September or October. The significance of this cannot be overstated. When Bitcoin ETFs were approved, they unleashed a wave of inflows and legitimized the asset in the eyes of Wall Street. Now that playbook may be repeated for a new generation of coins, offering more opportunities for diversification and growth. This confluence of policy, market innovation, and regulatory clarity is driving what many are calling the start of a new crypto supercycle. The question isn't whether digital assets will become part of mainstream finance. The question is, how fast? Retirement savers, institutional investors, and fintech innovators all stand to benefit from this unprecedented wave of adoption. So what does this mean for you, the individual investor? Whether you're a young professional just starting to build your retirement portfolio, or a seasoned saver looking to protect and grow your wealth as you approach retirement, the answers depend on your goals, risk tolerance, and understanding of the rapidly changing financial landscape. First, the possibility of adding cryptocurrencies to your 401k could offer a safe, tax-advantaged way to gain long-term exposure to assets like Bitcoin and Ethereum. Unlike direct speculation on exchanges, holding crypto in a retirement account means you can benefit from tax-deferred growth, professional oversight, and diversified investment strategies. This could be especially valuable as institutional adoption drives further price appreciation and reduces volatility. Second, keep a close eye on the ETF space. If XRP, Litecoin, or other altcoin ETFs launch in the coming months, early positioning could be key. ETFs offer the advantages of liquidity, transparency, and ease of trading, making it easier for everyday investors to gain exposure to a broad array of digital assets without the complexity of managing wallets or navigating exchanges. Third, understand that increasing regulation isn't a threat. It's a sign of legitimacy. The Genius Act and Trump's executive order both point to a future where cryptocurrencies and stablecoins operate within well-defined legal frameworks, attracting institutional capital and reducing the risks associated with regulatory uncertainty. This means more protection for investors, better access to information, and a more robust ecosystem for innovation. Of course, all investments carry risk, and the crypto sector is no exception. Volatility remains a hallmark of digital assets, and rapid price swings can be unnerving for even the most seasoned investors. But with trillions of dollars in retirement accounts now potentially within reach, and with clear legal frameworks guiding stablecoins and ETFs, the balance between risk and reward is shifting. As you consider your next steps, think about the broader trends shaping the financial world. Digital assets are no longer niche products. They're becoming integral to payments, savings, and investment strategies. Stablecoins could soon power every transaction, from buying coffee to sending money overseas. Altcoin ETFs may offer exposure to new technologies and markets, and cryptocurrencies in 401ks could democratize access to wealth-building opportunities previously reserved for the financial elite. For employers and plan sponsors, these developments present both opportunities and challenges. Offering crypto options in retirement plans could attract younger workers and tech-savvy professionals, but it will also require robust education, due diligence, and risk management. Financial advisors will need to stay informed and adapt to changing client needs, evaluating the role of digital assets in holistic financial planning. Meanwhile, regulators and policymakers face the task of balancing innovation with consumer protection. The Genius Act is a step in the right direction, but ongoing oversight will be needed to ensure that stablecoins remain truly stable and that retirement savers are protected from fraud and abuse. The Department of Labor's review will be critical in shaping the rules that govern alternative assets in 401ks, and industry stakeholders will be watching closely. Looking ahead, the ripple effects of these decisions could be felt across the global financial system. As the U.S. embraces digital assets in retirement plans, other countries may follow suit, accelerating the shift toward a more interconnected, efficient, and inclusive financial landscape. Payment systems will become faster and cheaper, cross-border transactions will be simplified, and new asset classes will emerge, offering fresh opportunities for growth and diversification. All of this points to a future where the lines between traditional finance and digital innovation are increasingly blurred. Retirement savers, investors, and consumers alike will need to adapt, learn, and take advantage of new tools and strategies. Whether you're bullish or skeptical on crypto, the reality is clear. The genie is out of the bottle, and the pace of change is accelerating. So, what should you do now? Start by educating yourself. Follow reputable sources, understand the risks and rewards, and consider how digital assets fit into your overall financial plan. If your employer offers crypto options in your 401k, review the details carefully, ask questions, and seek professional advice as needed. Monitor developments in the ETF space and be ready to act if new opportunities arise. And remember, diversification remains key. Don't put all your eggs in one basket, whether in crypto or any other asset class. Stay informed, stay flexible, and stay open to change. The coming months and years will be critical as new regulations, products, and platforms emerge. By staying ahead of the curve, you can position yourself to benefit from the next wave of financial innovation. In conclusion, today's news marks a turning point for crypto and alternative assets in America. With President Trump's executive order, the Genius Act, Ripple's expansion, and looming ETF approvals, the stage is set for a new era of investing. The opportunities are vast, the risks are real, and the potential rewards are unprecedented. Will crypto in 401ks send Bitcoin to $200,000? Could stablecoins become the backbone of global payments? Will altcoin ETFs spark a new investment boom? Only time will tell. But one thing is certain, history is being made, and the financial world will never be the same. Remember, this is not financial advice. Do your own research, consult with professionals, and make decisions that align with your goals and risk tolerance. The future belongs to those who are informed, prepared, and willing to embrace change. If you found this update valuable, stay connected for real-time insights and analysis on the evolving world of crypto, finance, and retirement investing. The next big move could be just around the corner, and you won't want to miss it.